Hey, how are you? Hope all of you are well. It's your CPA Manish here. I bonds, inflation bonds. Currently, they are making 9.62% returns per annum. And a lot of you have been asking me questions about inflation bonds, and that is what we are going to discuss today. We are going to discuss all that is involved in inflation bonds or I bonds. So I bonds has two components of returns. One return is called a fixed rate of interest. And this fixed rate of interest is fixed for the life of the bonds, which is 30 years. And this fixed rate since 2010 has been hovering around 0%. Even today, it is 0%. So the fixed rate of interest, which will be fixed through the life of the bond throughout the 30 years, is at 0%. And then there is a second component to the rate of return. The second component is a variable component. It is called variable because it keeps on changing every 6 months. Every 6 months, they revise the variable rate of return. It is revised once at the beginning of May, and then again it is revised at the beginning of November. And on I bonds, on inflation bonds, this variable rate of return, which keeps on changing twice a year, that is linked to the inflation, to the current rate of inflation. So for past so many years, this variable rate, the current rate of inflation was very, very low. It was low at like 2% or so. And that's why there was not a lot of traction, or there was not a lot of interest in I bonds or inflation bonds. But since lately the inflation has skyrocketed, the return on this variable portion has been up to 9.62% per annum. And that's where it has gained a lot of interest. That's where it has gained a lot of traction. And that's why all of you are so excited to learn more about this. But you have to remember that this 9.62%, which was declared in May of 2022, this year, it is going to remain in effect till the end of this month, till the end of October 22. And then again from November onwards, the return will change, the variable rate, the variable portion will change based upon what the inflation is going to be. Obviously, for next 6 months, from November till April, it is expected to be somewhere near to the same 9.62%, maybe a little less, maybe a little more, but it's going to hover around the same percentage. But remember, after next April, again on 1st May, depending upon the inflation, the rate is going to change. Again in November, it will change. Again in the next May, it will change. Every 6 months, this variable portion will change depending upon what the inflation is. Currently, it is high because inflation is high, but you have to keep this in mind that down the line in 6 months, 1 year, 2 years time, where the Fed is trying to control the inflation, if at all the inflation goes down, this rate, the variable rate, will also go down. That is one of the risks that you are taking when you invest in inflation bonds. The variable rate is dependent upon inflation. More the inflation, the better it looks at this point, but it could change in 1 or 2 years' time. So that is the risk you are taking. Be mindful of that. Now, how does this compounding work? So 9.62% is an annual rate. So for half the year, your rate is going to be half of it. And why I'm mentioning you half the year, it is going to be half of it, because the interest is compounded in your account every 6 months. So supposingly you invest in November, then from November, 6 months will be in April. At the end of April, the interest will be compounded into your investment, and your investment value will go high. The next 6 months, you will get interest based on the compounded amount. So interest is added into your account. It is compounded into your account every 6 months. And then on the compounded amount, the higher amount, the raised amount, the added on amount, you will get interest for the next 6 months. So this is something interesting because even if the rate of return is 9.62%, when the interest is compounded every 6 months and you get 9.62% on the compounded amount on the added on amount, your rate of return is going to be even higher than the 9.62%. Very interesting. One more interesting fact is, whenever you buy these bonds during the month, it is assumed as if you bought these bonds at the beginning of the month. Very interesting. So if you buy these bonds on 31st of October, you will still get interest for the whole month of October, even though you bought it on the last day and held it only for 1 day. It will be treated as if you bought it on 1st of October, and you will get interest for that whole month. Okay. Similarly, when you redeem these bonds, when these bonds get matured or you redeem sometime in future, if you redeem supposedly on 1st of April, it will still get you interest for the whole month of April. So this is again very intriguing, that the interest that you get is for the whole month, whether you buy it on the 1st of the month, in the middle of the month, or on the last day of the month, you get interest for the whole month. Similarly, when you exit, you get interest for that whole month, whether you sell it at the beginning of the month, middle of the month, or the end of the month. So what you should do, if you can plan, if the dates are in your favor, what is more favorable is to buy something at the end of the month and exit at the beginning of the month. That's how you get the whole month at the beginning and you get the whole month interest at the end. So this is something that you want to keep in mind also. The interest on these I bonds, these are not taxable or exempted from state and local income taxes. The interest on these bonds are exempted from state and local income taxes. You do have to pay tax, income tax on the federal level though. So on the federal, it is taxable. On state and local, it is not taxable. On federal also, there are a couple of exemptions that we are not going to discuss today. But if you use the interest for education purposes and you take care of cash flow in a particular manner, and if your AGI is less than a certain amount, then on the federal level also, you can get this interest exempted. But there are two things. Number one, it should be used for educational purpose and you have to adjust the cash flow properly. And number two, your AGI has to be within certain limit. If both those conditions are fulfilled, then on the federal level also the interest could be exempted. But on the state and local level, your interest is definitely exempted. So that is very good for people who are in New York City and paying state and city taxes almost 12%, or if you're in California paying 13% or more, this could be very beneficial to you. One more interesting fact, you get to decide when you want to pay tax on this interest. You get to elect when you want to pay tax on this interest. You can elect to accrue it every year. If you elect to pay tax on the accrued interest every year, then you will pay tax on an annual interest amount year after year. So if you are in a lower tax bracket and you want to continue to pay lower tax, you can accrue this interest annually and you can pay tax on the annual interest accrued year after year. That will be lower amount and lower rate of taxes. Alternatively, you can pay tax on all the interest on the date of maturity or when you redeem these bonds. So alternatively, you can elect that after 10, 15, 20, 30 years, whenever my bonds will mature or whenever I redeem the bonds, at that time, all the interest that I will get, I will pay tax on all that interest altogether at that point in time. You can decide to do this if you are in a higher bracket, and deferring the tax, deferring the income on this makes sense to you. This is like pension, not pay tax year after year, but only pay tax when you withdraw. Similarly, on this, you can elect not to pay tax year after year, but elect to pay tax all at once at the time of maturity or when you redeem it. So you defer taxes for all these years and pay at the end. You can elect, this is what you can do. You also have to keep in mind that these bonds are not really marketable securities. You cannot buy these from open market. You cannot buy these from banks or financial institutions. You have to buy these directly from Treasury. And similarly, this is not marketable security. You cannot sell it in the market. You cannot sell it to banks or financial institutions. You will have to mature or redeem it directly from the Treasury. So these are not marketable securities. When they are not marketable, you want to know what is the life of the bonds. The life of the bonds is 30 years. The life of the bond is 30 years, but you cannot redeem it before 12 months. The life is 30 years. You don't have to be in this investment for all 30 years. You can redeem it before 30 years, but you cannot redeem it in first 12 months. You have to hold these bonds for a minimum of 12 months. After 12 months, you can redeem the bonds. But if you redeem it anytime before 5 years, before 60 months, then they will forfeit the last 3 months of interest for you. So I'm telling you 3 things. Number 1, the whole life is 30 years. You do not have to be invested for all 30 years. Number 2, you have to be invested at least for 12 months. You cannot redeem before 12 months. You can redeem after 12 months. But if you redeem before 5 years period, before 60 months, then they will forfeit 3 months of interest for you. That is a kind of penalty. You will not get 3 months of interest. Okay. So I hope that clarifies the tenure of these bonds. Okay. Now, what are the limits on the bonds? So following are the limits. You can buy inflation bonds up to $10,000 per person per year. You can buy $10,000 per person per year. Okay. You can buy 10,000, your spouse can buy 10,000, your children can buy 10,000 each. Everybody can buy $10,000 per person per year from treasurydirect.com. You have to log into treasurydirect.com, and from there electronically you can buy $10,000 worth of I-bonds per person per year. But as many people you want to buy the bonds, so many accounts you have to open. So you each have to have a separate account. You each will get a separate account number. You each will have to create a separate login. And from that, every year, you each can buy $10,000. Very interestingly, you can also buy $10,000 per entity that you have. If you have a LLC, if you have a S corporation, if you have a trust, then for every entity, for every LLC, for every S corporation, for every trust, you can buy another $10,000. You will have to create separate accounts for each of them. Once you create separate accounts, you can buy $10,000 each. These are going to be through treasurydirect.gov, and these are going to be in electronic format per year, $10,000 each. In addition to electronic $10,000, you can also buy paper copies. You can also buy paper bonds up to $5,000 from your income tax return if you have a refund on your income tax. I repeat, other than $10,000 per person per year electronically from treasurydirect.gov, you can have another $5,000 per tax return. This is not per person. If you're married filing joint, it's going to be $5,000 total. It's not per person, it's per tax return. Per tax return, you can get $5,000 in paper bonds if you have a refund on that tax return. So now that we are close to October 15th, if any of you are going to file tax returns on extension, and if there is a refund on that tax return, up to $5,000, you can use from that tax refund and you can buy paper copies, paper bonds of these I-bonds. Now, keeping a track of all these electronic accounts year after year and keeping a track of your paper copies, that is very important. Many of these bonds, many a times remain unredeemed. They remain uncashed on maturity just because they are lost. Just because you might forget that you had these bonds sitting somewhere, or you did not communicate it to your family members, or you lost the paper copies, or for whatever reason. It's very important for you to keep a track of all these accounts and how much you have invested in which accounts, how much do you have in paper copies, and so on and so forth. That is one of the most important tasks. That is something that you will have to do on your own, because remember, there is no financial advisor involved here. You're not doing this through your bank account, investment account, or any other account who is going to keep a track of all these. So you will be yourself responsible to keep a track of all that you have in electronic format year after year in whatever accounts you have for yourself, for your spouse, for your family members. And then you will have to keep a track of how much you have in paper copies. It's not very difficult, but it is important to keep a track of all this. Okay. I hope all this information helps. If you have any questions, please feel free to let me know. Otherwise, I'll see you in next video. I hope this was helpful. Take care, and I'll see you next time. Bye-bye.